Your international dividend portfolio is not yielding what you think it is. Not approximately, not close. The number on your brokerage screen, the yield percentage that made the position look attractive, that made the international diversification case compelling, that made the global income strategy feel like the sophisticated move, that number has never once reflected the income that was actually going to arrive in your account. It reflected the gross dividend declared by the company. What arrived in your account was something smaller, quietly, automatically, invisibly smaller. And the mechanism doing the shrinking is not a market risk you evaluated before buying. It is a tax obligation that was always going to happen. That happens before the money ever leaves the country it originated in, and that most international dividend investors have never calculated into the yield comparison that justified the position in the first place. Withholding tax is the mechanism. Every country that allows foreign investors to receive dividend income from its domestic companies also reserves the right to extract a percentage of that dividend at the source. Before it crosses the border, before it reaches your custodian, before it appears in your account in any form. The withholding happens at the paying company's end at the moment of distribution. You do not receive the full dividend and then pay the tax. You receive the dividend minus the tax that has already been extracted, and the gross amount you never touched is what the yield calculation on your research screen is based on. The yield you evaluated was not the yield you purchased. You purchased the net yield. You just did not know what the net yield was when you made the decision. The rates at which this extraction occurs are not trivial, and they are not uniform. Switzerland withholds 35% of dividend income paid to foreign investors before treaty relief, meaning a Swiss company declaring a 5% dividend is delivering a 3.25% net yield to a U.S. investor before any reclaim process is initiated. Germany withholds 26.375% as a baseline. France withholds 30%. Japan withholds 20.42%. Even Canada, the international market most U.S. investors treat as functionally equivalent to domestic investing, withholds 15% on dividends paid to U.S. investors subject to the treaty rate. A 4% yield from a Canadian dividend payer nets 3.4% before any account-level tax treatment. A 5% yield from a French company nets 3.5% before the treaty reclaim process that most retail investors never successfully navigate. These are not edge cases. These are the largest, most liquid, most widely held international dividend markets in the world, and the withholding rates in all of them are material. The tax treaty system is supposed to address this, and this is where the gap between the theoretical framework and the practical reality of what retail investors actually receive becomes genuinely important. The United States has income tax treaties with most major economies that reduce the withholding rate on dividends to between 5 and 15% for qualifying investors. The U.S.-Germany treaty reduces the German withholding rate from 26.375% to 15% for portfolio investors. The U.S.-France treaty reduces the French rate from 30% to 15%. The U.S.-Japan treaty reduces the Japanese rate to 10%. On paper, the treaty system cuts the withholding drag by roughly half in most major markets. In practice, accessing that treaty relief is not automatic, is not consistent across custodians, and requires documentation, filing processes, and in some cases, active reclaim procedures that the majority of retail brokerage accounts are not set up to execute reliably. Here is the specific gap that most retail investors discover only after it has been costing them for years. Treaty benefits are not automatically applied by every custodian at every level of the account structure. The rate that gets withheld at source is the domestic withholding rate of the paying country unless the investor's custodian has proactively established a treaty relief procedure with the relevant foreign tax authority. Large institutional custodians typically do this efficiently. Retail brokerage accounts accessed through standard platforms vary significantly in how reliably this process is executed. And when the treaty relief is not applied at source, the investor's recourse is a foreign tax reclaim, a process that involves filing documentation with a foreign tax authority, in many cases in a foreign language. Following procedures that differ by country and by year, with processing timelines that can extend to 18 months or longer, and with success rates that are meaningfully below 100% for individual retail investors. The practical outcome for the typical retail investor holding international dividend positions through a standard U.S. brokerage account is a withholding drag that sits somewhere between the full domestic rate and the treaty rate. Closer to the treaty rate for large, well-resourced custodians with mature international processing infrastructure, and meaningfully worse than the treaty rate for smaller platforms. The blended effective withholding rate that most U.S. retail investors are actually experiencing on their international dividend income is in the 18 to 22% range. Not the 15% that the treaty framework promises, but somewhere in the middle that produces a persistent yield reduction that compounds against the investor over multi-year holding periods. The compounding impact is where this moves from an administrative inconvenience to a portfolio construction problem that demands explicit attention. An investor holding a 5% gross yielding international position experiencing 20% effective withholding drag is receiving a 4% net yield. Over 10 years with dividends reinvested, the terminal portfolio value difference on a $200,000 initial position is approximately $41,000. The tax is extracted annually. The compounding loss it creates accumulates for the entire remaining holding period of every reinvestment that never happened. The 2026 Global Trade Agreement landscape has introduced a specific new variable into this calculation that did not exist for most of the historical data. The current geopolitical realignment, the fracturing of post-war multilateral trade and tax frameworks, has created a treaty environment that is less stable than it was 3 years ago. Countries are revisiting those rates as broader trade relationships are under pressure. The treaty benefit that made a position attractive may not persist through the full intended holding period. The specific framework for evaluating international dividend positions correctly in this environment requires 4 calculations that most investors are not currently making. The first is determining the applicable withholding rate, the rate actually being applied by your specific custodian to your specific account structure. The second is calculating the net yield, gross yield multiplied by 1 minus the effective withholding rate, for comparison against domestic alternatives at equivalent risk. The third is assessing the treaty stability risk, identifying whether the treaty is currently under renegotiation or has been subject to unilateral modification. The fourth is calculating the reclaim opportunity, identifying where the withholding rate exceeds the treaty rate and where a reclaim procedure is economically justified. The international diversification case for dividend investing is not invalidated by withholding tax. Genuine geographic income diversification provides real portfolio benefits. The case is damaged when the yield comparison was made on a gross basis without the withholding calculation, because the position may be generating inferior net yield. The investors whose portfolios are actually delivering are the ones who made the withholding calculation before the position was initiated and who verified their custodian's actual process. The investors whose international portfolios are quietly underperforming are, in many cases, holding the gross yield number on their screen while the net yield in their account has been running 15 to 20% below it. The border is not just a line on a map. In dividend investing, it is a tax event, and most investors cross it without reading the rate.